Welcome to the weekly wrap-up where we take a look at what economic events were moving and shaking the markets this week. Today I am joined on the line by Lien, Managing Director at BK Asset Management. Thanks for joining me, Kathy. Which events this week do you think had the most impact on markets?
It's a toss-up between the ECB rate decision and the non-farm payrolls report. I think, first and foremost, the ECB rates decision sort of set the tone for trading on Thursday and Friday by, pushing the euro significantly lower and keeping it under pressure, and basically letting people realize that that the ECB is in a position where they have grown much more dovish and are leaning further towards easier monetary policy than many of the other central banks. So, that caused initial sell-off in the euro, and then it was exacerbated by the hot non-farm payrolls number that we have in the U.S. So I think, the main takeaway from both of these is that you've got Europe and Eurozone slowing and, facing even greater monetary stimulus. You've got U.S. economy recovering after the pullback in March, and the Federal Reserve comfortable with the current level of stimulus and probably still thinking about tapering asset purchases sometime this year. So I think that these are both very, very important and both something that we should take away from this week's price action.
And what did you make of the German Consumer Price Index figures released on Monday?
Well, overall, I think inflationary pressures in the Eurozone and even in Germany in particular have been on the decline. And that's part of the reason why the ECB was able to ease. I mean, CPI fell in Germany by 0.5%, and Draghi pointed to lower inflationary pressures in his statement as one of the reasons why they felt now is time to cut interest rates. So I think it's not a huge surprise because they had a pullback in commodity prices, but I also think that this is one of the reasons why the ECB was able to do what they did this week.
On Tuesday, Eurozone unemployment figures were released, showing an increase to 12.1% from 12%. What do you think this means for employment in the Eurozone area?
Well, I think that the labor market conditions in the Eurozone are weakening. I think, also labor market conditions were one of the things that Draghi pointed to in his monetary policy press conference. So, the labor market and inflation are both headaches for the ECB, and I think looking ahead, they don't just react to the data right now, they react to the data right now as well as the expectations for data going forward. So I think looking ahead, they're also anticipating some further increase in unemployment.
On Wednesday, the Federal Reserve announced in its policy meeting it will continue with its $85 billion bond purchasing program. How do you think this decision will affect the markets?
Well, at the time, it didn't affect the markets that much. But now I think that it's something investors will reach back to as they look to how the dollar can move in the coming week. Because the Federal Reserve was relatively nonchalant. I mean, they basically, my main takeaway, there were a lot of different interpretations of that. My main takeaway was that they had no major concerns about the labor market because even though the FOMC rate decision was off the heels of that abysmal non-farm payrolls report in the month of March, they didn't even change their labor market assessment. Of course, on Friday, with this hot non-farm payrolls number, they were pretty much vindicated, and their glass half full view of the job market was validated. So I think now people are going to look at it and say, okay, the Federal Reserve didn't change their stance all that much, and so this means that they're still looking to taper asset purchase probably later this year.
And on Thursday, the European Central Bank cut rates to 0.5% for the first time in 10 months. What are your thoughts on this?
Well, in terms of the rate decision, it was a big one. I mean, granted, the ECB prepared the market for this cut, and that's why when they actually cut, the euro rallied initially. It wasn't until Draghi came out and said, all right, we're considering negative deposit rates as well, that the euro reversed its slide. But I think that this is, in terms of monetary policy, this is a big deal because it reopens the door to more stimulus. But I think that the comments that you heard from ECB President Draghi in terms of being willing to consider negative deposit rates is an attempt on their part to appear more flexible, when in reality, they probably will be very conservative and very careful about any additional action that they will take. And part of the reason why I say that is because on Friday, we had some conflicting comments from other ECB policymakers who say the market may have overinterpreted the possibility of negative deposit rates. So I think, it was part of the effort to signal potential change, but in reality, they're probably not as ready and willing to do it as they would otherwise suggest.
Lastly, what do you make of the US non-farm payrolls released today and the US unemployment figures for April?
Well, the numbers are good. I've mentioned how they were pretty hot throughout this conversation, and I think this is going to renew demand for U.S. dollars as people look around the world at who's easing monetary policy, who's keeping them unchanged, and so I think it's quite possible that we're going to see the dollar extend its gains.
That's all for now, but before I go, I'm going to leave you with some expert quotes from some interviews conducted by our journalists this week. Have a great weekend and goodbye for now.